Hey, what is up everyone, it's David here. Warren Buffett's Berkshire recently disclosed what they bought and sold, and so did Stan Druckenmiller's Duquesne family office. So in this video, let's take a peek at what they've done to their portfolio and see if there's any hidden gems that we've missed. By the way, I've documented my process on how I screen for high quality stocks in this video right here, and looking at what institutional investors are doing is part of the process. So if you are interested in that video, I'll leave a link in the description box below. As usual, this video is not financial advice or recommendation to do anything. It's just general information for entertainment purposes. So the way this video is going to work is I'm going to look at some highlight of those portfolio changes first, and then I'll dig into the individual holdings. And based on the individual holding changes, if there's any interesting companies, I will look into the historical financials or the valuation just to see if there's any hidden gems we've missed. So let's start off with Warren's Berkshire, because it seems like they have exited some of their financial positions. At the same time, they've also added in insurance broker Aon. And it also seems like they have slashed their Wells Fargo position further, but they have also amped up their position in Verizon and MMC. So I'm just scrolling through the rest of this article to see if there's anything we need to pay attention to before we look at the actual portfolio changes. As I was reading, this was really interesting to me because I am not directly exposed to insurance companies. I'm indirectly exposed to it via index funds. And personally speaking, I'm honestly not that interested in insurance companies, but seems like Warren is getting in early while Aon is looking to close the deal with rival Willis Towers Watson. So we might take a look at the historical financials in just a second. So I'm just scrolling through the rest of this article to see if there's anything that stands out. And it seems like they have also cut their Chevron holding by half. Now, the way I look at Berkshire's holding changes is via Whale Wisdom. Now, Whale Wisdom essentially pulls the fund's 13F filings and then display it in this way so that we can see how the changes have been made in the portfolio. This is a free tool, and I've documented my process on how I screen for high quality stocks. That would be a great video to watch next if you are interested in things like these. But let me just explain how I interpret this table, essentially. Now, the first three columns is pretty obvious. Percentage of portfolio is just how big is the position in the portfolio. And obviously, Berkshire is a massive fund, right? So their biggest positions are in the billions. And then the previous percentage of portfolio is just what was it before. And then the changing shares basically are telling us whether they have bought and sold. And then percentage ownership is what percentage of the company do they own. And the quarter first owned means when was their first position. And this is estimated, so please take this with a grain of salt, how much they have essentially paid for that share. Now, sometimes with a company like Berkshire with so much buying power, you can actually negotiate a better deal. Quarter end price is essentially what is the price towards the end of the quarter reporting. So again, we don't actually know what price they actually sold at. So again, take this with a grain of salt. Recent price is recent price, and source is just the filing source. And then source date is which quarter of the filing, and then when is it reported. Now, the problem with these 13F filings is that it's usually reported a month and a half late. So by the time this is released, their portfolio could look very different. So again, take these portfolio changes with a massive grain of salt because it's completely old news. But it's really good for retail investors like us to just gauge in terms of how institutional money managers are changing their sentiment or managing their portfolio. It's just good education nonetheless. So the first thing I like to do when looking at these filings is to look at the boring stuff first, which is what they've sold. And if you just click on filter by reduced, you can see a list of companies they've reduced. And if you pull your mouse over the stock, you can actually see, okay, so this is US Bancorp, and they have reduced their position by about 1%. And GM is General Motors, and they have reduced their position by about 7%. And they've also sold at a relatively high share price as well. But even if they reduce 7%, they're still holding a crap ton of GM shares, right? The market value for these shares are humongous. And this is Chevron, I believe. And they've reduced their position by about 51%. Maybe this is Warren changing their thesis when it comes to fossil fuels. You know, we'll have to wait for them to give a little bit more clarification on why they did that. And it's really interesting to me that they've reduced their position in Abbey, Bristol Myers, and also Merck. Now, they have reduced about 10% in Abbey, still a lot, by the way. And it seems like they have got a very nice premium out of this. And they've also reduced their Bristol Myers as well. Now, one thing I want to remind you of when it comes to Warren Buffett's style of investing is that he's a long-term buy and hold kind of guy. So when you look at these companies, when he reduced his position, he invested in US Bancorp since 2006. It's been a very long time. I'm not really interested in the rest. So let's look at what they have added as new. So when it comes to their new position, they have added Aon. And this is their only new holding. And they added almost $1 billion worth. Now, Berkshire is actually sitting on quite a bit of cash, so $1 billion is actually not a lot of money. And you can see that this is a tiny position compared to the rest of the portfolio. So let's look at some financials for Aon. So when it comes to financials, I am just going to look at ticker, look at estimates. I'm going to drag the timeline just a little longer. And then I want to look at revenue. I want to look at EBITDA, and then I want to look at free cash flow. So I'm going to scroll down, look at free cash flow, and just trying to gauge, whether the business is growing before I do more research. It seems like the revenue is plateauing, dived over here, and then started to grow again. These 2 years are estimates, so you got to take it with a grain of salt. I'm going to remove revenue for just a second, just so that I can see whether the free cash flow have been growing. So the free cash flow since 2017 have been growing quite nicely, and it seems like it's anticipated to continue to grow. And Warren Buffett is adding, around this period right here. So in 2021. And he's a long-term buy and hold kind of guy. So if I'm interested in insurance, I'll probably dig a little deeper. But because I'm not that interested in insurance, this is interesting. So I'm just going to keep it on the back of my mind. I want to see if there's any positions that he have added to. Verizon, he has added more into it. And that's Kroger, I believe. It's added a lot, actually. Added about 52%. And his current position is worth about $1.8 billion, and he owns 6% of the company. That's massive. And RH, I believe, is a furniture company. And this company is quite ridiculous. So before we take a look at the historical financials, RH is an upscale American home furnishing company. And if you're wondering how expensive, I took a look at the bedside table for this company, and it costs $1,000 for a bedside table. It's $800 for members, so that's a nice discount, but it's definitely not for folks like me, right? Like, I'll be way too cheap to buy $1,000 bedside table. But in saying that, if we look at the historical financials, I pulled numbers from 2014 all the way to today and some estimates. And you can see that the revenue has been growing pretty consistently and very nicely. And it doesn't seem like the pandemic have actually impacted them at all. And what's really interesting is that if you look at this transition point right here, you can see that from 2017 to 2018, they really upped their free cash flow game. Now, that probably requires more research because that might have been an event or change of management, something would have happened here to cause this change, or they've just executed against their plan. And since then, their free cash flow game has been just growing consistently. Even though the financials look good, one, I'm not interested enough in expensive furniture companies, and two, I'm not familiar with it. I don't know what it feels like to pay $1,000 for a bedside table. So Stan Druckenmiller's Duquesne family office is a lot more exciting. So let's look at some highlights, and then we'll look at some individual portfolio holding changes. Now, it seems like Druckenmiller have added Citi into their portfolio, which is super interesting because they had a really tough time during the GFC. Never quite recovered. And Duquesne have also boosted their position in Starbucks, Expedia, and also Disney. The thing to remember is that with Stan Druckenmiller and also Warren Buffett, Druckenmiller is not exactly a long-term buy and hold guy. He can also change his mind overnight. So don't expect holdings from 2006. So that's just something for you to be aware of. Again, with this article, I'm just looking for any standouts, just so that we know what we're working with, and then we'll look at the individual holdings. And it did say that they have added a new $154 million position in Citigroup, small stake in JP. So that would be a thesis on rising interest rates, because as interest rates go up, the banks tend to make more money. And he has sold out of Disney, Carnival Corp, and trimmed some of their position in Carvana. So let's take a look at their individual holdings. Again, I use whale wisdom to look at what portfolio changes are done. So first things first, let's get the boring stuff out of the way and look at what positions have he reduced. So it seems like he has reduced some of his FANG exposure in Microsoft, Amazon, but they have been holding this for the longest time since 2015. And his estimated average price paid is about $1,800. So probably more than double his money at one point. So this is T-Mobile. It seems like they have reduced their position from about 8% to about 5% of their portfolio. Palo Alto Network, I'm not familiar with this one, so no comments. And the rest of these reductions are very much similar in nature, I think, because C Limited is a Southeast Asian consumer internet company. Melli is an e-commerce company focusing on South America, and this is Cloudflare. So a lot of these are growth stocks, and the macro environment is not going to treat any of these nicely. And at the same time, if we look at the average price paid and when he first entered, he would have made bank on these anyway. So it could be both a risk management move or just locking in some profits, have some dry powder on the side to get ready for the next correction, whenever that comes. So quite a bit reduction in growth stocks. So let's look at some of the new positions that they've added because I think it's crazy interesting. So let's start off with Citigroup. We already know that they have added a pretty big position in Citigroup. What I was not anticipating, that Duquesne added almost $139 million into Palantir. It's 3.5% of their portfolio, and they currently own about 0.3416% of the company. I was not expecting Duquesne to go in that deep for Palantir because obviously the macro environment is not going to treat this company nicely. But let's take a look at Palantir's financials, right? If we take a look at the historical financials for Palantir, this is relatively a new company, so not too many historical data points to go off of. But we can see that analysts are expecting the company to grow by 37% over the next 2 years. And this is a software company, so their EBITDA margins and also their gross margins are going to be incredibly great. And it also seems like they are going to go free cash flow positive in 2021 and 2022. Maybe the people who have studied Palantir a lot more can tell me whether that is realistic. As it stands, I haven't studied it enough to give proper comments around whether they can go free cash flow positive in 2021 and 2022. But it seems like to me that Stan Druckenmiller have enough conviction to build a position this big in Palantir. So let me know if Palantir is on your watch list at the moment, and I'm just deciding whether that is going to go on my watch list. It seems like Duquesne have also dedicated 1.73% of their portfolio to Intuit. And I've actually talked about Intuit in the past, comparing that to our Australian darling called Xero. So let's quickly take a look at Intuit's historical financials and comparing it with Xero. Now, this is 3 years worth of actual data and 2 years of estimates. And you can see that from a graph point of view, yes, everything is growing. But if we look at it from a numbers point of view, the analysts are expecting that Intuit's revenue will grow by 15% compounded annually over the next 2 years. And EBITDA is growing at a rate lower than revenue as well. So that might be signs of margin compression, but that requires a little bit more studying just to see if that is indeed the case. So if we do the same thing for Xero, look at 3 years worth of actual data and then 2 years of estimates, you can see that their revenue growth rate is higher, but they are coming off of a lower base. And analysts are expecting that Xero will grow their revenues by around 27% over the next 2 years, compounded annually. But their EBITDA margins are growing by around 68%. Compounded annually. So that is essentially telling us that there is margin expansion with the company. Whenever EBITDA is growing faster than revenue, it's a sign of margin expansion. So they're making more money. And one of the ways to also check is look at the gross margin percentage. And this does seem like there is margin expansion. Now, I am not sure why there is a 52% gross margin for 2022 estimate. So that could be a mistake, or there is some kind of expectation that their margin would deteriorate to that point. I am really not sure. And then we'll look at the free cash flow. There is minimal free cash flow at the moment from Xero because Xero is a tech darling over here in Australia. So definitely on the early stage of growth compared to Intuit. But when we look at valuation between these two companies, you can see that Xero is the black line, blue line is Intuit. Xero is growing faster, but does it justify and 89 times forward EV/EBITDA when compared to Intuit, which is growing at around half the growth rate with way better cash flow, but at a 30 times EV/EBITDA. Even though I think that Intuit is a better value play when comparing to Xero, I'm not interested in Intuit enough to add it onto my watch list. So let's look at what else is here. Now, it seems like Duquesne have also added a position in Coupang, and Coupang is a South Korean e-commerce company that have recently IPO'd in March. Since IPO, this company have corrected by almost 27%, and the macro conditions are not going to treat these companies well. However, in the long term, this is on my watch list, but not anytime soon. The rest is pretty straightforward. I was pretty surprised to see Snowflake here and also Tiger here as well. Tiger is a competitor to Futu. Think of it as the Asian equivalent of Robinhood. So let's look at some of the positions that Duquesne have closed out of. A lot of it is information and tech related. Fastly, for example, CyberArk even closed out an ETF around semiconductors. They've also closed out their position in Disney, which was pretty substantial at the time, and have also closed out their CrowdStrike position, which is interesting. I wonder if that's just their sentiment changing, getting out of overvalued growth stocks. But from this list, I'm really not that concerned. And the last thing I like to do is look at what positions have been added to. And it seems like Starbucks have been added to quite a bit, and it's about 6% of their portfolio now. So let's look at some historical financials for Starbucks because I am intrigued. So we're going to look at revenue, look at EBITDA, and also free cash flow. So it seems like it has been a little bit turbulent on the Starbucks side, and maybe the reopening trade will essentially boost these numbers up. Now, if we reduce the timeline a little bit, just to kind of put things in perspective, because of the pandemic, analysts are expecting Starbucks to grow by 15% over the next 2 years and 47% EBITDA over the next 2 years. Okay, that's pretty interesting. And free cash flow as well is going to, wow, what? These are estimates, by the way, so never trust these. I will probably add Starbucks to my watch list as a form of value play, but we will see. It was getting a little hot, so I had to get rid of the jacket. Based on your own interest and preference, you can see that I picked out different companies to go onto my watch list, and this is definitely one of the things I do to filter for high quality ideas to go on my watch list. And it doesn't necessarily mean that I will ever have to pull the trigger on these, but it does give me inspiration and also education on how they're managing their portfolios given the macro conditions. And I think if you're in the mood for another video, how I screen for high quality ideas are a great video to watch next. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.